Greetings, everybody. We continue our portfolio management series. This time we are looking at the 5 most common portfolio mistakes. So at Pure Portfolios, we have a service, a free portfolio review. So when reviewing these portfolios and providing our prospective clients feedback, I noticed some themes. So what I've done today is compiled these themes into a list. And as you can see, it's the top 5 most common mistakes. So I hope you gather something from this. I think these are easy fixes, and it doesn't take much to veer a little off path. And as you'll see, many of these issues compound off each other. So if you get headed down the wrong path, it can actually snowball and make a small problem worse. So I hope you take something from this and can use it to improve your portfolio. So I'm going to share my screen, the most common portfolio mistakes and what you can do to fix it. So I'm going to highlight 5 and then have a solution for each one. So let's get into it. Number 1, a random collection of stuff. So this doesn't take a whole lot to have a portfolio where you're just collecting funds over time. It could be changing jobs. So going from saving in a 401k to leaving it in a 401k and moving on and starting another 401k, or rolling your old 401k into an IRA. Maybe you've switched advisors a few times, and all of a sudden you have a mutual fund salad, as I call it. And I just have an example here of some random holdings. But as you move through time, as you change jobs, as you change advisors, maybe you're a part-time do-it-yourself investor on the side, you add all of that together, and it's quite easy to accumulate a bunch of stuff. So the solution is to create intention. You should ask yourself, what role does each holding play in my investment plan? And what I often see is really small holdings, right? So you might have 100 holdings and 80 of them are so small, even if the best case scenario or the worst case scenario plays out, it's not really going to make an impact. So make sure every fund, every ETF, every stock, every bond, there's intention behind it, and it complements what you're trying to do from an investment standpoint, and it complements your financial plan. Pitfall 2, assets spread across 6 to 12 different accounts. And again, this is completely normal, where you would have a 401k, maybe you have a Roth, you have a traditional IRA, you have a health savings account, you have a taxable joint account. Let's say you're married, your spouse might have the same, and all of a sudden you have 6 to 12 different accounts. That's not an issue per se. What is an issue is if you have multiple like accounts. And what I mean by that is you have multiple 401ks out there. You have multiple traditional IRAs out there. Not only is this a problem from a logistical standpoint, from a tracking standpoint, knowing what you own and how much risk you're taking, it can create a logistical nightmare when you start to take funds out of those portfolios, out of those accounts. So especially if you're getting ready to retire, you shouldn't have 3 or 4 401ks floating out there. I'm going to get to the reasons why. So combined like accounts, you shouldn't have 3 IRAs. You should have 1 IRA. Again, as you start taking your RMD, as you start taking your distributions out of those accounts, it's going to make your life, it's going to make your CPA's life a lot easier. Pitfall number 3, know what you own. And again, these pitfalls piggyback off each other. So if you have a random collection of accounts, a random collection of funds, multiple accounts, you have mutual funds that have these opaque names. Like I've been doing this for almost 20 years. I could not tell you what these funds actually own just by looking at them. I'd have to go in and examine the fund, examine the risk metrics and all that good stuff. So if you own some of these opaque mutual funds with these exotic names, it can be very difficult to know what you own, which again doesn't really matter when markets are going up, but in a year like this, your outcome could be amplified or you could get ambushed. And I've had many people tell me, I thought I was conservatively invested. I didn't know a potential loss of 30% was possible. And it's because it's not obvious what they own. So again, I wrote in here, can you guess the stock and bond allocation for the above portfolio? I cannot, and I do this for a living. So get rid of exotic, opaque mutual funds. And this kind of piggybacks off number 1. Know exactly what you own and know why you own it. So create more intention around your investment portfolio. And an easy way to do this, really there's 2, you can load your holdings into a portfolio aggregation tool to understand risk and range of outcomes. So you would simply find the ticker symbols for each holding that you own into a aggregation tool and be able to see risk, potential outcomes, what you're paying in fees, what you're paying in mutual fund expenses. That's a necessary thing to do at least a few times a year, especially if you're doing it on your own. If you're working with an advisor, this is basic 101 stuff. They should be presenting this to you. If you need help, if you want the help of a professional investor, find a fiduciary. I have CFA in here. So CFA, Chartered Financial Analyst, that's been called the gold standard of investment management. If you find a good CFA, a good fiduciary advisor, they should be able to help you do. Number 4, taking risk off the table. Which lever to pull? So it's easy to buy and hold when markets are going up. It's less easy to do that when markets are going crazy. You should have a process for managing risk, meaning if something happens, what is your process? An orderly, non-emotional process for making buy and sell decisions. And again, when you go through this exercise, these pitfalls piggyback off each other. If you own a random collection of funds, if you have multiple accounts and you have no clue what you own, it's going to be impossible to have a orderly, well thought out process for making allocation changes and managing risk. Okay, so optimize these first 3 pitfalls. Suddenly this becomes a lot easier. Of course, you need to consider taxes. You need to consider the size of each account type. And the solution is fix 1 through 3 and then develop a process to making portfolio changes. Making emotional decisions based on short-term market moves or what happens next, that's not a process. The more decisions that you make, the more likelihood that you're going to be wrong. And as you get close to retirement, if you're retired, the stakes become higher. And I really encourage you to tighten up this process before something happens. A lot of people think that good portfolio management is staying the course. Markets are down 30%. That's the time to go in and make a bunch of changes. No. The time to optimize your investment portfolio and to create these frameworks, to manage risk, to know what you own, to create intention, to consolidate accounts is before something happens. And the last pitfall, and this is quite common. This is probably the most common thing that I see is many investors, especially do-it-yourself investors, piled into big tech. They piled into US large cap. And look, that's been a pretty good trade. For the last 12 years, that's been the best performing asset class. Not unlike previous cycles, most retail investors chase performance, and they end up getting way over their skis, way over allocated to yesterday's winners. As we've seen this year, markets can move quickly. They can move in cycles. What was a winner yesterday might not be a winner tomorrow. Conversely, what was a loser yesterday might be a winner tomorrow. So make sure you have balance. Make sure you have a framework for managing your position sizes. It's easy to FOMO, the fear of missing out, to the best performing asset class. Last year it was digital assets, so cryptocurrency. This year it's energy stocks. Again, yesterday it was big tech. So have a plan. The solution is to have a plan for managing your position sizes. For example, you might say the max weight for any sector or technology stocks, let's say in this example, will not exceed 10% of my portfolio. Okay, that's a non-emotional rule that maybe once a quarter or once a year you go in and check your sizing across stocks, sectors, asset classes, just to make sure that you're well within the range of target weights. Okay, so there you have it, the 5 most common portfolio pitfalls. So let's just review these really quick. Random collection of stuff. Assets spread across 6 to 12 different accounts. Know what you own. Right? It's not obvious what you own if you own a mutual fund salad. Taking risk off the table. Create a framework for managing risk. Money's emotional, investing's emotional. It's easy to be a buy and hold investor. It's easy to be a bullish investor or an aggressive investor when markets are going up. Much less harder to do that when markets are going down. Lastly, create position target weights so you're not FOMOing, you're not chasing performance. It's easy to do. A lot of investors pick what funds they allocate to based on past performance. That is not going to end well in most cases. So again, just having a plan for managing your target weights, your max position weights in your portfolio can avoid all that. So there you have it, the 5 most common mistakes. I hope you can take something from this. If you have any feedback, if you have any questions, if you want us to do a free review on your portfolio, feel free to email insight@pureportfolios.com. Thank you.